Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Diane King Hall. We have an hour to go in the trading days. Let's take a look at where things stand. We're still looking at gains across the board. The Dow up just over 100 points. S&P up just about 0.5%. The Nasdaq up by about 0.6%. 10 of the 11 S&P sectors moving to the upside. The gains here being led by materials and energy. Let's get to our top story of the day for the markets. The reason why we're seeing some green on the screen, and that is the May Consumer Price Index. Inflation cut in half from the peak level, but prices are still up 4% from where they were a year ago, very far from the Fed's 2% target. So what does this mean for the Fed's decision on rates tomorrow? Joining us now, we want to bring in Tiffany Wilding, PIMCO Managing Director and Economist. Tiffany, it's good to see you here. So inflation, the lowest reading that we've seen in just over 2 years. Is this enough for the Fed to pause tomorrow?
Yeah, I mean, I think that they were pretty clear that they do want to pause at the June meeting. Fed Chair Powell, as well as the Vice Chair to be Philip Jefferson, I think both sent pretty strong signals that they do just want to pause at the June meeting. You know, and obviously the inflation report today was probably a sigh of relief for them. In that regard, but I do think this is one print. It's moving in the right direction, which is fantastic, but they're going to feel like they're not out of the hot water yet. So they're going to want to see a string of prints and have more confidence that inflation is going back to 2% for them to, fully take additional rate hikes off the table.
Tiffany, Diane here. I want to ask you, is this a sustainable path downward? We are seeing inflation starting to improve. It has been sticky, but again, this is a level that we haven't seen in quite some time now. So is this kind of a glass half full or glass half empty way we should be looking at this? And what about core CPI?
Yeah, well, I mean, so we've said that, obviously there's still pandemic related effects that are impacting the global economy, the global manufacturing process, and obviously domestic inflation. And we've said for CPI, going from 8 to 4, for example, will be relatively easy because you still have those pandemic related effects that were fading. Obviously, energy prices that have come down, they haven't doubled this year. So that's been quite helpful. But then going from 4 to 2, would take a little bit more time. So we do think there's still some road ahead of us here. Our own forecasts do have core CPI inflation going down to 2%. And then it is kind of remaining stickier, and that the Fed maybe not really hitting their target even next year. But I do think that the moderation that we've seen and that we will continue to see over this year probably will be enough to eventually get them to pause. We think they probably hike rates again in July, but after that, they're probably pretty close to the top of their rate hiking cycle at this point.
Tiffany, if the Fed does stop, at least for now, or pause tomorrow, is it harder to restart at all once they pause, just given what that could signal here to the markets?
Well, I think that the Fed has, as they always do, a bit of a tricky task for communication, because ultimately their job is to keep financial conditions tight today. And doing that will help bring down inflation in the future, right? So they basically need the markets to continue to price in some probability of future rate hikes. They need to convince the markets that the next move is just likely to be up as down in order to keep financial conditions tight today. So I think they will continue to try to emphasize that in their communication. I think one way that Chair Powell could do that at the press conference is he could say, we didn't hike interest rates today at our June meeting. However, it's possible that we could hike interest rates again at future meetings. We could even move to an every other meeting pace, and then obviously being data dependent within that framework. So I think he's basically, all of this is to say he's going to do whatever he can to, to continue having traders think that there's some probability of additional rate hikes in the future, even if they are what turns out to be at the top of the rate hiking cycle.
And then, Tiffany, in terms of the cycle, so obviously the expectation is for that pause tomorrow. If there are extended rate hikes down the line, how many more do you see and how long do we stay there?
Well, I think it really is obviously going to depend on the economy. And I think the Federal Reserve officials need to see more evidence. I think both in the inflation data, as well as in the labor market data, the tight labor market is resulting in upward pressure on wage inflation. They need to see clear evidence in both of those indicators that that monetary policy is working. And so, I think one of the problems with this is obviously those indicators are lagging indicators. So, I think they probably will continue to have this bias to continue to hike interest rates while we're seeing a strong labor market, and relatively persistent inflation. But they've done a lot so far. Monetary policy is restrictive. This will filter into the economy. We think it will start to slow things down more obviously in the second half of this year. And when that happens and things become more obvious, then they'll probably feel more comfortable to stop hiking interest rates.
Tiffany, how big of a slowdown then are you expecting in the second half of the year? And you just mentioned the labor market part of all this. How much slowdown, or what do you think the employment picture needs to look like in order to see substantial improvement from here on inflation?
Yeah, well, so just in terms of the labor market, we think that the so-called SOM rule is actually quite a helpful little rule of thumb here. So the SOM rule basically suggests that when the labor market, the unemployment rate increases by about 50 basis points, historically, the U.S. has been in recession. So we think the Fed officials on a real-time basis will probably use something like that rule. So they'll probably need an increase in the unemployment rate by 50 basis points or more, before they, start cutting interest rates, for example, when and have confirmation that the U.S. is in recession. Now, we do think ultimately that recession risks are high here, and we think the U.S. could slip down into a mild recession, by the end of this year or starting early next. And that's just because historically, when you've seen central bank hiking cycles like this, that have had the magnitude and the speed that we've seen, usually you do get an economy that's going into recession, kind of around 2 to 2.5 years after the start of that hiking cycle. So that, this time around ends up being kind of around the turn of this year. Of course, things could be longer this time. They could be shorter, but I think it's reasonable to think, given everything that the Fed has done, that we will slip down into a small recession, and you will see the unemployment rate rising as a result of this.
But Tiffany, you are starting to hear other analysts, et cetera, kind of pushing back the view for a recession this year. And I got to ask you, what if employment remains tight? I mean, this labor market has been a tight labor market, as you mentioned, as many other analysts and economists that we've talked to. What if this is just the new normal?
Well, I think ultimately it's a little bit tricky, right? Because it can't be the new normal in some sense, because the Federal Reserve doesn't want inflation where it currently is. They do want to get inflation back to 2%. Maybe they allow it a little bit above that. But so because they don't want inflation lingering at these higher levels, this can't be the new normal for the labor market. They need some labor market weakening in order to get inflation back to those levels. So I think ultimately the question here is, what level of the federal funds rate of interest rates, what level do they need to be in order to get that weakening labor market? And I think that's kind of what we're probing for right now. 5% is a level that, we think is restrictive, but it might turn out that it's not restrictive enough, in which case, the Fed will have to hike interest rates more. On the other hand, though, it's certainly possible that, we haven't seen the full effects of monetary policy tightening. And when we do start to see that, it could become very clear late this year into 2024 that, the Fed has done enough to get inflation back down. So, obviously we'll just have to see.
We will see, and we'll see what the message is from Powell tomorrow. Tiffany Wilding of PIMCO, thanks so much.
All right, investors taking the inflation print in a stride, with stocks posting modest gains heading into the close. Our Jared Blickery is here with a breakdown of the market action. Jared?
Well, thank you, Diane. Let's take a look at the left side of the screen there. All green in the U.S. markets. I want to point out the Russell 2000, which is up 1.3%, almost double that of the NASDAQ. And I'm just going to go to a comparison chart here of the NASDAQ versus the Russell 2000. This is intraday. You can see Russell 2000 in cyan a little bit higher. But here's what's happened over the last 10 days. Why 10 days? This goes back to the non-farm payroll report that we got a week ago Friday. And in that time, the Russell 2000 is up 7% over the NASDAQ's 3.5%. This is important because up until that point, it had been mainly the NASDAQ outperforming all year long. You take a look at what sectors are in vogue now, it's a different story. Here we have materials. This is just today. Materials, that's XLB, up over 2%. Industrials, consumer discretionary, energy, real estate, 3 of those are the value and cyclical sectors. To the downside, only utilities about unchanged there. The mega cap sector is taking a little bit of a backseat, but that's how a normal market works. You have some things going up, not necessarily everything at once, and just waiting their turn until other sectors can come into play. Now, this is unusual for the beginning of a bull market. Now, if this is a bull market you believe started last October, guess what? In a bull market, usually everything goes up in the beginning and then you start getting some sector rotation. That didn't happen, but maybe it is different this time. Here's our leaders and sentiment indicators for today. Meme stocks, those have been picking up recently. KWEB, that's a Chinese internet ETF. We'll take a look at that in a second. That's up 2%. So are regional banks. So is retail. And just to go down the line here, let's just take a look at some of the sectors which I haven't spent a lot of time on, but which have been picking up recently. Here's the energy sector. I'm going to go through these quickly. Here's regional banks. You can see a lot of green here on your screen. Also taking a look inside, here are the industrials. This is what makes the economy go, the stuff that people are building to help the economy. All this is very important in a bull market, so it's good to see this, want to see this continue, and we just have to get by that next Fed meeting, the hurdle of which is tomorrow, but the CPI data, that's out, that's in the bag, and that was a huge hurdle that we just crossed.
Oh, indeed. Wow. The bull run definitely continuing. Jared Blick-Reed, Professor Jared, as I like to say.
Thank you.
Thank you. All right, we're just getting started here on Yahoo Finance Live. Coming up, we're under 24 hours from the Fed's decision on interest rates. We'll continue to preview what to expect from the FOMC. Plus, the chairman and CEO of AMD, Lisa Su, joins the show next hour to discuss the latest in AI. You don't want to miss that conversation. And former President Donald Trump entering a not guilty plea in the classified documents case. We get legal analysis later this hour.
Investors largely expect the Federal Reserve to hit the pause button at their policy decision on Wednesday, but tomorrow's consumer price index could prove to be a last-minute game changer for the Fed if it clocks in hotter than expected.
They probably left us with enough in terms of Fed speak and then the labor report for May itself. That was probably enough to set us up for, if you want to call it a skip. I guess that's the new word now for June. But I think more important would be language around what it means for July, if it was a hotter number yesterday. And then even along with that, I think some of the wage data, that to me is going to be more interesting moving forward.
If you look at market-based probabilities, there's about a 25% probability that the Fed raises rates this week. But if you look out to July, that's increased to about 53%.
The focus of the week is going to be CPI because right now people have priced in again for the Fed to pause. But if CPI comes in hotter than expected, if inflation remains stickier than people think it will, then that maybe shifts the Fed at the last moment.
It looks like you've had this sort of continuous period of inflation. But the first wave, which was about consumer durable goods, that was demand-led. That's over. The second wave of inflation was supply-led, and that was the energy shock coming out of the war in Ukraine. But then the third wave of inflation, the one we're getting now, is this unusual profit-led inflation story.
The statement of economic projections could arguably be critical. Growth and inflation numbers have come in stronger than expected. So that would in turn suggest that maybe that the Fed have to revise the dot plot higher as well. How does the market get convinced that a pause does not equal a dovish pivot? Well, one way to do that would be via the dot plot and moving those plots higher.
Breaking news, former President Trump entering a not guilty plea to all of the criminal charges he faces in the classified documents case. The charges include mishandling classified information and obstructing justice. Trump arriving in the Miami courthouse just over an hour ago to turn himself in and get booked. His aide and co-defendant Walt Nauta arrived at the courthouse with Trump and surrendered. And this is the first time a current or former president has ever faced federal charges. After this appearance, Trump will be heading back to New Jersey and is scheduled to speak tonight at 8:15 p.m. Eastern. Well, consumer prices showing signs of cooling in the latest CPI print. Annual headline inflation coming down to 4% in May. But overall core inflation remaining sticky, rising 0.4% last month. So how is this going to impact the Fed's decision on rates tomorrow? We want to bring in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, it's good to see you here. So taking a look at the market action today, it looks like they are viewing this as even more evidence or a higher chance that the Fed is going to pause tomorrow. What do you think?
Yeah, I think it's put a little skip in Chairman Powell's step. Maybe we don't get a rate hike at this meeting. Maybe July would be the last one. I think we're going to get the dot plot. Of course, we're going to get the dot plot. We're going to get Fed Chair Powell's comments, which may signal a bias towards maybe one more hike at the July meeting. But look, even with the data we got this morning, we can't entirely rule out a rate hike. It's unlikely. But look, we saw surprises from the Bank of Canada last week and the Reserve Bank of Australia last week. They both had paused hikes in prior meetings and then had to come back and hike again. This is the risk for the market, getting more and more comfortable around the idea that we are at the end of this series of rate hikes. The Fed remains data dependent. And if the data surprises with inflation in the coming months, as it could potentially do, as we saw in Canada, Australia, other major countries, that's a possibility as we look out over the course of this summer, particularly given potential developments with regard to the war in Ukraine and so many other factors that can influence prices.
Jeffrey, Diane here. I want to ask you, okay, the expectation largely for a pause at tomorrow's meeting. At the following meeting, do we see the Fed kind of continuing to hold steady, or do you anticipate it's going back to another hiking cycle?
At the moment, the market seems very convinced of another hike. One of the reasons why I think that's possible is if we take a look at something called the output prices component of the Purchasing Managers Index. The PMI is a survey of purchasing managers at businesses around the U.S. In fact, it's done around the world. And they ask, one of the questions they ask is, what are you getting on pricing? What's your outlook for pricing on the goods you're selling over the course of the next several months? And that is usually a 6-month leading indicator of where overall consumer prices are headed. It's actually a really good indicator over the last 20 years. And that's pointing to inflation in the U.S. halting its decline, remaining sticky around this sort of 3 to 4% range over the next 6 months. That may keep the Fed from being able to declare all clear on the rate hike front. So even though we may just get one more in July, they may not be able to tell us that's absolutely the end of the cycle.
Jeffrey, what do you think is priced into the markets at this point, just in terms of there's so much riding just on how Powell shapes the narrative at the press conference tomorrow?
Well, certainly some of the high-flying tech stocks, particularly AI names, very, I think, tied to this environment of the return of a flood of liquidity, maybe the potential for the Fed to be cutting rates aggressively less than a year from now, and all that liquidity flowing into those, we know, liquidity-dependent type of stocks. So I'm a little worried about the very narrow leadership of the U.S. stock market, where we've really seen those stocks run away. In fact, the average stock in the U.S., looking at the equal weighted index, is only up 4 or 5% from the end of October, where the bear market ended. So really not seeing broad participation. That's not true, however, outside the U.S. We were seeing a bull market in the average stock up 21 or 22% for the EFI index since the end of October. So much broader, and I think able to withstand further rate hikes by the European Central Bank, whereas in the U.S. we might be more vulnerable if the Fed doesn't signal an all clear after July.
Jeffrey, we're hearing the R word less and less, recession. I got to ask you, you've talked about this indicator, it's a lesser known indicator, the cardboard box recession. Tell us what you're seeing on that front. And, again, we're seeing the R word less and less. So what are you seeing, and what is your data showing you?
Well, it depends where you're looking, right? So in the U.S., you might be hearing less about it, but last week's news makes it official. Europe is in a recession. In Q4 and Q1, they both had back-to-back quarters of negative GDP. The mildest ever is a total of negative 0.2%, but they are in a recession. It's not too surprising, but it's also too much of a generalization. Not everything is in a recession right now. It's what I'm calling a cardboard box recession. In a typical global recession, all areas of the economy turn down. Manufacturing, trade, services, retail, and construction, for example. And they do so around the same time. But now, only manufacturing and trade seem to be in a global recession. So I'm referring to it as a cardboard box recession. Things you make and ship tend to go in a box. And demand for corrugated fiberboard, that's what cardboard boxes are made out of, has fallen to a similar extent we've seen in past recessions. You can see it here in that chart, that purple line heading down, similar to what we've seen in those shaded periods of recession in the past. That's in contrast to service industries, which are still doing very well. So far, it's just a cardboard box recession, but I'm a little bit worried in the second half of this year. It comes out of the box, spreads a little bit into the service sector, maybe if the job market softens up.
So, Jeffrey, what does this mean then for investors? If you're out there trying to put money to work, you're looking at your call here, what you're seeing in terms of the trends of a cardboard recession, how should that then dictate where they are seeing or where they should be putting their money to work at this point?
So I think you want to focus on, remember the fact that there's probably going to be a good bit of volatility in the second half of this year with divergent economic trends and central banks unable to give us an all clear on the inflation front. And again, I think you want to look to markets where there's a higher quality component, meaning companies able to self-fund out of cash flow. They're not dependent on tighter financial conditions. And you can find more of those outside the U.S. I'd point to Japan right now as a market that's doing very well. By the way, avoiding recession in the last couple of quarters, booming growth, and actually seeing really strong performance. In fact, this is the 10th week in a row of gains for the Nikkei 225, something they haven't seen in 10 years. So this is a really strong performance in that economy as it's bucking the overall trend to global weakness, seeing stronger profit growth and still very attractive valuations.
But what about here in the U.S., Jeffrey? I mean, this hasn't quite been a broad-based rally yet. We are in the early stages of a bull run outside of, I guess, what's been dubbed the Magnificent Seven. What sectors are you seeing or do you suggest where investors should be playing?
You know, we're really focusing more on characteristics than sectors right now, meaning focusing on companies with higher quality characteristics, low price to cash flow, good interest coverage ratios, right? Those are the companies who've been outperforming for the last year or so. I think they're going to continue. But if I had to pick a sector, one of the unloved ones right now is energy. You know, energy, oil prices just hit a real low, 3-month low yesterday. They're rebounding now. I think prospects for better growth in China as they're likely to cut rates this week. They cut overnight rates yesterday or this morning, but they're likely likely to cut their one-year medium-term lending facility rate on Thursday. We're also seeing cooling tensions between the U.S. and China. Secretary Blinken is headed over there on Sunday after CIA Director Burns visited last month. So maybe tensions are easing a little bit. And I'd note that we're also seeing some pretty strong activity in terms of a profit revival there and some revival in consumer confidence. So looking at the demand picture for energy, particularly just coming from China alone, could be a brighter picture here as Saudi Arabia further cuts output kicking in next month. All that points to brighter outlook for the energy sector, which is often tied to the outlook for crude prices.
All right, Jeffrey Kleintop of Charles Schwab. Thanks for joining.
Meanwhile, New York office occupancy rates broke through 50% this week, marking a new post-pandemic record. In fact, over 50% across various markets. That's according to Castle Systems' Back to Work Barometer, which tracks building security swipes across major cities. But ongoing vacancies within commercial real estate has the industry still working on pivots like conversions to residential. Here in New York City, one major project is in the works in Lower Manhattan, turning a former office into apartments. Yahoo Finance's Danny Romero is here with a closer look. Danny?
So this makes a lot of sense on paper, but there's a lot that goes on with these conversions. One example to this is the 160 Water Street in Lower Manhattan. That used to house medical offices. Now it's going to become a residential area for residents locally. It's going to be a mix of studios as well as 1-bedroom to 2-bedroom apartments at market rate. And this project is a step in the right direction. It'll bring more supply to the market, which is needed. The major perk, though, to these conversions is the speed of construction. They aren't essentially starting from scratch. They already physically have the building. But there's a lot of characteristics that the building needs in order to move forward with these projects. That could include zoning, tax breaks. But another side to this that was really interesting that I heard from one developer is that since the banking fiasco, there's a lot of demand. Take a listen.
We've probably studied over 125 buildings in Manhattan alone for potential conversions. A lot of these were office buildings that were, arguably struggling before the pandemic with leasing. And we're not sure if they're ever going to get back to being viable office buildings again. So again, we haven't seen as many turn into real projects as we had hoped, but there's definitely an uptick in demand, and a lot of developers, especially those that had a heavy office portfolio, are really interested in this moving forward.
So you can hear that demand is there. There's also a need, but it will really come down to state laws really moving the needle forward.
And Danny, when it comes to these conversions that we are seeing, of course, then there is the question that, yes, people aren't going back to the office full time. So these companies don't need maybe the full office space that they did have. But many of these are operating on a hybrid sort of environment. So how do they kind of straddle those two scenarios?
Well, hybrid is here to stay. We're seeing that even with us.
Right.
So some of these developers are really thinking outside the box when it comes to these office conversions. So let's just take a listen to what one developer says.
One of the things that we've seen in a lot of these conversions is you naturally end up sometimes with deeper units. That sometimes plays into a nice home office further into the floor plate where you don't need that along the window. That's attractive to renters and buyers for having a dedicated space to work from home, which a lot of times you don't get in typical cities apartments because they're so small. And then again, having them located in prime central business districts where a lot of these office buildings are located also sort of feeds into this trend of kind of having, more mixed use districts where work or home are closer together.
And after getting an inside look at 160 Water Street, the consensus is that a lot of these amenities are outside. They really want to build out the terrace. They want to add a playbook. They want to give their residents extra space to escape from essentially the city and also enjoy a nice view if they do have one.
Yeah, I'm not surprised to see these kind of conversions happen. New York has gone through that before, and it's something that they've needed to do within the industry, especially with these empty spaces still happening. And we've had this conversation before about the difficulties of converting commercial real estate dedicated to office to residential. So there are some challenges there, but I'm not surprised to see this kind of trend continuing.
Yeah, demand is there, so.
Certainly just so much of that extra office space, at least here in the city. All right, Danny Romero, good job, thanks. Make sure to stay tuned tomorrow, stay tuned next hour, not tomorrow, next hour. We're going to be speaking with the Altman Brothers team co-founder Josh Altman on the high-end real estate space as our continuing coverage of real estate, the new reality here on Yahoo Finance. Well, coming up, Donald Trump facing a federal court in Miami this afternoon. We've got to look at what is next for the former president when we come back.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Shares of Tesla trading higher today, up about 3% at the moment, on track to extend a record run to another day in a row. Yahoo Finance's Pras Subramanian joins us with the story. Is this all about the charging network, Pras?
Some of it, yeah, a big part of it for sure. I mean, we're talking about a 13-session win streak here, longest on record. Stock up 40%, over 40% during that time. I mean, a huge run up in just 13 sessions, like I said. Stock up over 100% this year. So yeah, like you said, yes, big part of it, those charging deals. We saw that end of last week where GM and Tesla struck that deal for GM to use those networks, those plugs. They're going to have the Tesla plug in their cars starting 2025. Follows the deal from 2 weeks before with Ford. Was kind of surprised when Ford did it, even more surprising that GM kind of followed in their footsteps, because at that point, they probably have the user sort of customer data showing that their customers do want that. But a big part of it, was that stuff. But also the general overall tech trade lately. A lot of optimism for the Fed rate pause, right? A bullish data this morning for the CPI. So that's all part and parcel to that big tech trade, the big momentum, high valuation, high growth tech stocks. So Tesla's a big part of that.
Yeah, certainly working in the favor here of Tesla investors. But Pras, there was some troublesome headlines that came out about the Cybertruck. What are we learning there, and how do you think that this could potentially maybe disrupt the timeline of this debut, if at all?
I was surprised that this didn't give it a kind of a roadblock here for shares, right? So basically, a German newspaper published some basically leaked reports from the company talking about how they're concerned about the Cybertruck and its sort of basic operations like suspension, body sealing, noise levels, handling, braking. They were not happy with the truck's performance. Wired kind of looked at these reports and spoke to some experts, and the experts said, Tesla has the money to address these concerns. They can do that, but they were shocked that this late in the game, the truck was having this many problems. So kind of a concern there, but not for the stock. I mean, like I said, up 13 days in a row, big moves there, and I think it's just investors are all systems go at this point, even for the Cybertruck.
Yes, even if the Cybertruck is not necessarily all systems go, the stock is certainly all systems go. Pras Subramanian, thanks to you as usual.
Former President Donald Trump pleading not guilty to the 37 criminal charges over his handling of classified documents. Trump is the first U.S. president to ever be indicted on federal charges. Here with more on what's ahead for Trump in his legal battles, we have former federal prosecutor Gene Rossi. Gene, it's good to see you here. So just first talk to us just about what's unfolding right now down in Miami, the process in which former President Trump is undergoing today.
Well, first thing I want to say is this is the most historic indictment ever presented to a grand jury by the Department of Justice. So it involves the President of the United States, of course. I hope and pray that he gets the full panoply of due process rights because he is assumed innocent. Now, what are we going to expect? We're not going to expect a trial this year. That's a given. There are too many things that have to be done. They're going to set a series of dates for filings of motions, maybe status hearings. They may set a tentative trial date next year, but the first thing that's got to be done is how do you handle the tranche of classified documents that will be presented to the jury if it goes to trial? These documents are incredibly precious to the intelligence community. And there's an act called the Classified Information Procedures Act that sets forth hearings on how to protect that information if it's presented in a criminal prosecution. So that hearing will essentially be a mini trial, and that probably will occur in the fall. The trial itself, if I had to predict, it's very likely this trial won't be held until after the election of November of next year.
Gene, Diane here. Got to ask you, Trump has talked about this being unfair and calling it political. You think back to, the probe into emails for former Secretary of State Hillary Clinton, and obviously it was found that she wasn't charged. You have Biden having some classified documents and issues, a probe into that. Is this fair? Is this political?
I can tell you this right now. I worked for the Department of Justice for almost 30 years. Jack Smith is not a political animal. He's prosecuted John Edwards, Senator Hernandez in New Jersey. Okay, he doesn't care whether you're an R or a D. That's number one. Number two, Hillary, Mike Pence, and Joe Biden did something that Donald Trump did not do. They cooperated fully with the Department of Justice. They turned over all the documents that they had or emails. All right, that takes it to another level. If Donald Trump had returned the documents that they found in his various homes when the archives folks asked him to, if he had done that, he would never have been charged. But what he did was something that prosecutors love if they want a conviction. He got a grand jury subpoena for the documents, and then he thumbed his nose at it and tried to get his attorneys to join a conspiracy to obstruct. That takes it to another level. You can't ignore that conduct. You mustn't ignore that conduct because it makes a mockery of the judicial process. So is it a political prosecution? Absolutely not.
Gene, what about the strength of this case here? You just mentioned the fact that this is so historic. The first former president here indicted, or president in general, indicted here on federal charges. When it comes to what is in this case, the fact that it was brought here by Jack Smith, how strong do you think this is?
Okay, I go back. President Trump, whether you love him or hate him, okay, he's presumed innocent. But the allegations, if they are proven, are pretty darn bad. Okay, if you're going to look at this indictment, and if you don't have a lot of time to read it, I'll give you two quick paragraphs. Paragraph 6, paragraph 54. Those two paragraphs are devastating. Paragraph 6 involves when he's on tape in July, I think, of 21, and he's either at I think he's at Bedminster, New Jersey, where he's admitting it's not classified. He's admitting he didn't unclassify it, and that it's really bad stuff. That is on tape. Paragraph 54 are the alleged statements he made regarding his conversations with attorneys, where he's essentially playing, Mafia Don and asking his attorneys to help him obstruct justice. Those two paragraphs, if proven, are very bad.
Gene, I want to ask you, so he is still the Republican frontrunner, and you said this trial is likely not going to happen until 2024. If this does take that timeline, what happens? Like, what if he wins the election, and where are we with this?
Okay, in 1920, Eugene Debs ran for president from prison. And the reason he was able to do that is, he didn't win, of course. The reason he was able to do that is, if you go to the Constitution, there are 3 requirements to be president. 1, you got to be born in the United States. 2, you have to be 35 or older. And 3, you have to have resided in the United States for 14 years. You can be a felon convicted of first-degree murder and be elected president of the United States. The Constitution doesn't prohibit it. It's up to the voters whether they want to accept that.
Gene Rossi, we will have to leave it there for today. We appreciate you and your insight on this case and this uncharted territory we're in. Thank you so much.
Thank you.
All right. Coming up, we go around the horn and check in on some of the top trending stories of the day. Stay tuned.
Federal prosecutors unsealing an indictment outlining 37 charges against former President Donald Trump for mishandling classified documents after leaving office and then blocking the government's attempts to try to recover those documents.
I'm more interested in the political ramifications of this. And it seems to me that any Republican who veers into thinking that this is a serious issue that compromises national security is not going to fare very well among other Republicans. And I think that's one of the more interesting aspects of this case. The politics of it are going to be just stupendous to watch.
Somewhat amazingly, this does not really hurt Trump among Republican voters. He retains a sizable lead in the polls, and in some ways, this seems to benefit him among his supporters. He may end up convicted of crimes by the time the election is actually held in November of 2024. How do we spin this forward for the market? This is probably a reasonably good outlook for markets. If it's Biden, markets are good. And if it's another Republican, Republicans generally are friendly toward markets and toward businesses. So I think that's pretty good too.
If the stock market is right, we've really still got a stock market rallying by the end of next year, and inflation has come down immediately to 2% by that point, and there isn't terrible unemployment. Whether he's indicted or not isn't going to make much difference.
Let's take a look at some of the top trending stories of the day. We got Josh Schaefer, Alexandra Canal back at the table here to help us break it all down. We got to start off with one of the trending stocks of the year, and it's a trending story today with Apple. Apple getting a downgrade here from UBS. Some of the fear here just about the fact that iPhone sales are going to slow. Some of that growth is going to slow in the second half of the year. From this note, the analysts there are saying that we do not believe Apple shares offer a compelling risk-reward right now, especially in light of that soft iPhone PC and also the App Store fundamentals over the next 6 to 12 months. So it really speaks to a few things here. One, just the demand right now, the appetite among people who are already Apple users to get a new phone. But then two, the fact that people are pulling back some on their consumer discretionary spending.
But what's interesting, although it dinged the stock a bit, I wouldn't say it took a bite out of Apple. Sorry, had to throw that pun in there. Maybe more like a nibble. I mean, look, it's down 0.3% there, so not much. It's really hard to stop the run that we're seeing in Apple. Especially like even when you go back to its last split, it was at $100 a share for that split. And look at how much it's run up since then. So it's hard, although it does trade at a significant premium. So I see, kind of their point. But you have more than 2/3 of analysts still bullish on Apple.
Yeah, overall, it's kind of a valuation call, right? What you're going to see in names like this as they do run up, Apple up over 40% to start the year. So this analyst actually has a $190 price target on the stock, too, which makes it move the price target up today from 180 to 190, which in theory is still showing some upside on Apple over the next couple months. But one chart that I did find interesting here was just taking a look at sort of when you think about Apple's growth, you think beyond the US, right? And you take a look at that chart on your screen now, you can see how Greater China revenue has really fallen off. Also, Japan significantly lower there. And then the point that they really made in the note is if India is supposed to be a growth part for Apple, a growth country for Apple, they're just not a big enough part of the market yet. So where do you grow? Maybe it's that iPhone 15 alley. Maybe that's somewhere where people buy. But right now, when you're talking about just the next quarter or two, it doesn't look overly bullish for iPhone sales.
Right, and I think over the long term, we're going to see that pick up because Dan Ives from Wedbush, he made a good point. He said in his current analysis, roughly 250 million iPhones have not been upgraded in over 4 years, and that sets Apple up for some major upgrade cycles down the line. I actually just upgraded my phone a couple months ago. I only had
what do
one.
we have?
Well, now I have the 14 XR. I got the big guy. I also do like my cheetah.
We love a little cheetah print.
But the main reason I upgraded was because my battery life was running it was so hard to charge it. So that's how Apple gets you. And they just find a way to keep people in their ecosystem.
Some of that may have been apps, and they had a problem with that years ago in terms of that's why they had that, the payout that they had to do with consumers because it was found that they were throttling. So I don't know if that's happening as much now. But to your point about do I need a new iPhone? No, but I literally started thinking about, I pay attention to the next cycle that's coming out and seeing what's new, what's better, and they kind of capture you in their ecosystem. And one more quick note I wanted to say just about the India call and their point in the note about India. Look, on their last earnings call, Tim Cook was bullish on India. So it's interesting that you see the analysts saying, maybe not so
I just think
fast.
it's going to take a long time to develop, right? They just put their first store in India. So we need, there's a lot of work to be done there for it to become their next true emerging market.
Yeah, and also just going back to your valuation point where we started here, just to put all of that in context, it's trading at 29 times estimated earnings, which is a 50% premium to where many of its peers are. So just in that short-term view, I think that's a big issue with UBS right
And
now.
that's at a 10-year high compared to the S&P 500 too. That was also in that note. Impressive. Even high for Apple too, right? But Apple has been trying to get into sports streaming, and we're taking a look at a different potential sports streamer, I guess, today with Netflix. Netflix saying that they want to get into live sports streaming. At least this is per report from the Wall Street Journal. So the Journal coming out and saying that Netflix is going to combine two of its already sports products that it offers when you think about what it's done with Formula One and Drive to Survive and golf in Full Swing. So they're going to take characters from both of those, so professional golfers and professional F1 drivers, put them on a golf course, mic them up, and stream a live event from Las Vegas. At least per the Wall Street Journal, that's what's going to happen. I personally don't love it. I'm so sick of celebrity golf tournaments and people thinking that we're interested in this. I think that was a pandemic peak. It was fun when there weren't any sports and I was bored. There's real sports on now. I don't really care about watching people play golf.
Well, hopefully they don't fumble this one like they did. Sorry for the sports pun there. Like they did with Love is Blind, right?
It'd be a swing and a miss. Right?
Exactly. There we go. That's a better pun.
More broadly, what I was going to say, I wonder if they're really using this more just in terms of their experiment and practicing with live events before maybe they potentially reach some sort of partnership with sports. I don't know.
Look, I think it's smart just because to actually get live sports content like we've seen with Apple and Amazon, it's so expensive. And Netflix has repeatedly said that's not an area they want. So rather than that, they're focusing on documentaries. They're focusing on creating their own live sports content, creating these cast of characters that are then becoming viral that they can piggyback on essentially in order to create more content. So I think it's a smart move, and I've spoken to many experts that the live sports arena in general is pretty much untapped right now in the streaming space. I think there's a lot of more that you can do there, and I think it's smart that Netflix is taking a different approach.
Why do it?
Because
content.
No. But why this teaming up? I'm saying, like, it just in terms of the demand for that, I don't see this being.
You're leveraging. I guess I said I didn't like in the beginning, and now I'm playing the other side, right? But you're leveraging the characters that you have, right? So it might make me like Max Verstappen more, or someone from F1 more. It might make me like
and that gets
Brooks
the
Koepka
loyalty
more,
factor.
right? So then it gets you back to watch the next season of Full Swing, I guess, because this takes them. Those live golf events, I will say, if anything, you do hear a little bit more of the athlete's personality than you normally would because they're on a hot mic. So you can the announcer, whoever's emceeing the event, can mess with them a little bit. And so it feeds into their own content. I think it's more about that than it is about sports.
And Full Swing was rolling when the PGA Live Golf merger was announced. So they're probably going to tease that a little bit with this celebrity tournament. So Netflix is very smart. They're always thinking one step ahead, and I think that is the narrative moving forward at this company.
Yeah. Maybe. I don't know. I'm just skeptical. I mean, you guys have laid out very, very strong cases for why Netflix would do this in this exact pairing when it comes to F1 Drive to Survive and with the golf. What was it called?
Full Swing.
Full Swing. Yeah. I watched some of it, but I got a little bit bored. To me, that's why I'm not fully on board with all this. But it does make sense just in terms of their broader play here, entry into live events, and what that could look like for Netflix.
Yeah, and they have live events. They have a lot of international content like Squid Game. And Squid Game was actually one of the first series to get me into closed captioning. And that's what I'm watching today, because apparently that's what all the young kids are doing. They are watching content with the captions on. According to a May survey, 70% of adult Gen Z respondents and 53% of millennial respondents said that they watch content with text. And if you compare that to older respondents, there was only about a third of those that said that they did that. So it's transitioning from people watching closed captions because they can't hear versus people just like it more. They concentrate better. I think people have gotten used to seeing that on social media and TikTok. I know I personally do it. I find
Oh, I do it all.
I
I do it all the time. It's a multitasking. So I'll speak to the senior citizen side of this table. I do it. It's not because I haven't lost this yet, my hearing yet, but I do. I think it is, to your point, a habit from social media. I do also like the accessibility factor.
Mm-hmm.
Like, this is providing accessibility for people who are hard of hearing. So that is a nice feature. But my main reason is definitely the multitasking aspect. But one thing I know that stood out was some people are doing it because of accents, right?
Oh,
with
yes.
some shows and
Bridgerton.
some actors.
Oh yeah, that's why I use it.
Yeah.
One of my favorite shows was Peaky Blinders when they're speaking English, but they just have very hard accents to understand.
I was going to say it's easy when, or at least to me, it became a little bit addicting. I started using it when I started watching Downton Abbey, and sometimes when they're speaking a little fast, it's hard to follow with the British accent. So I started using it there and then fell in love with it, and I use it across the board with social media too. You can see we have up on the screen some of the hardest to understand actors.
Yeah. Two of those, I don't know. I mean, I could see Arnold Schwarzenegger being a little difficult to understand sometimes. Sean Connery, come on.
Tom Hardy in Peaky Blinders.
Yeah.
In Peaky Blinders, it's very hard to understand in that show.
Okay, so.
Case in point. But overall, it's good for the streamers, right? Because it makes your library bigger. And I think that's the biggest thing here is you can now offer us something that we wouldn't have been able to watch before. The Spotify documentary or series that's featuring Daniel Ek is all in subtitles. Pretty good.
Yeah.
But I would have never watched it because it's in Swedish.
With the rise of AI and everything like that, I think there's going to be a lot of developments in this space. Apple is exploring, when you're FaceTiming someone, you can get the closed captions of what they're saying. So there's only going to be more of this. And now there's a lot of options too. You can pick your colors, you can pick your font. It's not just one size fits all, because I have contacts, I have bad eyesight, not hard of hearing, but bad eyesight.
Closed captions in the headset. That's what I'm excited for.
Yeah,
Once
that's
we're all
true.
wearing headsets. Once we're all wearing headsets 24/7, we can get the closed captions in there.
Sitting on this table in 10 years.
Some people right now are watching us with closed captions.
Yeah.
You never know. All right, guys, we gotta leave it there. Josh, Allie, thanks so much. Coming up, we are counting down to the closing bell on Wall Street. Once again, gains across the board. Dow up 121. We'll be right back. There you have it, the closing bell on Wall Street. Let's take a look at some of the action here. All three of the major averages ending the day to the upside. The NASDAQ, the outperformer, once again closing up just about 0.8%. Move higher coming amid more signs that inflation is easing just a bit. We got some good news here on that CPI print before the bell this morning. In terms of the sector action, materials, the outperformer of the day, followed closely by industrials, energy, and consumer discretionary. Let's get into some of the day's big movers. For that, let's start with GameStop, closing the day higher, up nearly 11% after Executive Chairman Ryan Cohen increased his stake in the video game giant by about $10 million to over 12%. This comes after the company terminated its former CEO, Matt Furlong, last week. Also reported results that did disappoint many on the street, but you can see it doesn't take much for some of these GameStop fans to jump right back into the market with this name, and certainly Cohen adding to his stake was enough to do it today.
Yeah, still remains the largest shareholder, but again, a far cry from where we saw it during the meme stop frenzy. And also, look, GameStop still has the problem of the transition from physical to digital downloads. I mean, it's probably been a year since I've been in a GameStop myself. I know I'm just one case in point, but they really have to deal with that. That's a real business problem for the company. Meantime, shares of Man U surging double digits following a tweet from a Qatari publication saying that a bid from Qatari businessman Sheikh Jassim was a success, up 13% on the day. Now, earlier this month, Jassim submitted his fifth and final offer for the club, but there are reports saying not so fast, that still is conjecture at this point. And Shauna, you and I talked off the side about this because it started with a small tweet initially and then got elevated by a larger publication.
Yeah, lots of speculation over this. Again, the account that initially tweeted this doesn't have too many followers, so there's lots of questions just about how reliable some of this information is, but it was enough to drive the stock higher today. Now, we know the Glazer family, they announced a formal sale process of the club late last year. These negotiations have been ongoing now for just over 7 months. We know one of the other bidders in this British billionaire, Jim Ratcliffe, he is said to have wanted to purchase around 60% of the club. So we'll see exactly how all this shakes out. But again, the day shares closing higher just by about 13%. Let's check in on Delta. Shares also up just about 3.4% this afternoon, 13th straight day of gains. Now, this comes amid solid summer travel demand. Flight searches are up 25% overall for June through August compared to the same time last year. So I guess the beginning of June through right now, they're up pretty substantially. Obviously, we've been talking about this pent-up demand to travel, to get out there, this upswing here on optimism that people are still willing to spend. They're buying flights and they're eager to go places.
Yeah, Delta carrying United and American higher as well off the back of that. United also up 3%. So seeing a similar uptick there. American Airlines up just 1%. So not the same level of stamina as well. But again, definitely seeing that pent-up travel demand play out in terms of how investors are liking what they're seeing.
Yeah, certainly. We're seeing gains across the board there. All right, well, the business buzzword of the year so far is AI, and Salesforce CEO Mark Benioff thinks that the excitement is warranted, telling our own Brian Sazi why he sees it as a game changer.
Well, we've seen a lot of exciting waves of technology in our industry, the cloud, social, mobile, but this AI wave is going to be the biggest that anyone has ever seen. I think that the success of OpenAI is the point of evidence that this is going to be one of the fastest growing moves, not just in the consumer market, but in the enterprise market.
One of the fastest moves. Let's talk about just how fast and how excited we should be. We have Rishi Jalloria, RBC Capital Markets software equity analyst. Rishi, it's good to see you again. So we just heard, obviously, Benioff very excited about this. You've been covering the tech space for a while. How big of a deal is AI and the potential for this technology going forward?
Yeah, great to see you, and thank you so much for having me. Always great to be here. Look, I think, even though people are worried, is there too much hype here? I think definitively say, based on everything that we're seeing out there, conversations we're having, this technology is for real, and it will change the way kind of everything happens, right? If we think about through my lifetime, there's been really 4 major technological revolutions that have just changed everything, right? The first one was the internet back in the 90s, and think about what that's done to society. The second was cloud, and you think about Salesforce, you think about AWS. The third was mobile and the iPhone and Android. And now the fourth one is really generative AI. And part of what makes generative AI so significant is not only how powerful it is, but how easy it is to use through applications like ChatGPT. That's really what democratized AI, and I think shows, not just how powerful it is, but how flexible and how widely deployed it can be among every knowledge worker. And I do truly believe this is going to be very, very transformational technology. I think investors have to be very careful to pick and choose their spots and not get caught up in too much hype.
Speaking of picking and choosing their spots, Rishi, so who would you categorize as the market leaders? Of course, you have Microsoft and some other big players like we talk about Salesforce as well. Who would you say are the market leaders in this space, particularly when it comes to generative AI?
Yeah, Microsoft is a clear one, but I think there's a whole category of software companies that can see benefits from generative AI over the near term and long term. And I think it's really important that they have to be beneficiaries in the long term, not just something that's 1 or 2 years of benefits before it starts to taper off. And so from that vantage point, beyond Microsoft and Salesforce, I would think about companies like HubSpot, which is completely re-architecting around being ChatSpot, which is their chat first functionality. I would think about a couple vertical software companies like Vivo in the pharma industry, where they have a huge data advantage and they can help customers verticalize these LLMs. I would think about MongoDB in the next-gen database space, where this can accelerate a lot of those migrations off legacy systems like Oracle. And then I would think about companies like NICE in the contact center space. Contact center is one area that I think is going to be massively disrupted by generative AI. And I think, as being the leader in software providing solutions to call centers, this is really going to be huge.
Rishi, when it comes to so much of this hype surrounding AI, Bank of America was out with a fund manager survey today talking about that there's really this sense out there that there's this fear of missing out when it comes to AI, and people are so eager to jump in. What's 1 or 2 red flags that you think investors need to keep in mind when they're trying to pick some of those winners out there that you were just talking about?
I think there's a couple really good ones. First, I would think about the fact of, is this company actually doing what is truly AI, or are they calling their solutions generative AI and just paying lip service to it? And I would draw the analogy to the earlier days of the cloud, where you had some companies that said they were doing cloud, but really it was the same software solution just hosted in the cloud, versus companies that like MongoDB that truly re-architected for the cloud. So I would think, number one, are you truly doing AI? And then the second thing I would think about is ultimately, is there a path to monetization? And if there really isn't a path to monetization, I think that's going to be a little bit of a struggle. I think, generative AI is going to benefit everyone. Every single company will have a generative AI strategy. I'm out here in New York at our FinTech conference, and every single company I'm talking to is saying, we need to figure out generative AI. But I think the open-ended question mark is, can you monetize it, or does this become table stakes? And I think for those companies where it does become table stakes, there's really not that far for them to run, and you're going to get a lot of margin hit. Whereas I think companies that can monetize it, like Microsoft, like HubSpot, like MongoDB, whether it's directly or indirectly, I think they're going to be a benefit. So I would think that the 2 big things are, is this technology real, and is there a path to monetization?
And Rishi, I got to ask, so lawmakers are obviously looking at AI, particularly generative AI now. They're having initial conversations. We have some senators having conversations today about it. One, they're coming at it from 2 different ways. One, how does America continue to maintain leadership in this space? But also, there will be conversations about the regulatory climate. Who stands to lose if there is more regulation when it comes to generative AI?
Yeah, look, I would say the companies that believe their advantage with generative AI is having actual customer data, not business data, but individual consumer data as a way to train these LLMs, those are the ones that I think are going to be the most hurt. Whereas I think the more enterprise-focused players, where the data they have is more general insights into the industry or around processes and workflows, they're going to be a lot more insulated from the regulation. So I would be, kind of careful when companies say, oh, we have a big data advantage. I think the question is, well, who owns that data? Who has the right to data? And what is the legislation overhang? I don't think Microsoft has that risk, because it's an enterprise software company. And a lot of the insights they're providing aren't, specific about enterprise data. It's more about kind of the history of how people have interacted with software rather than specific data around users or around consumers.
Rishi, when it comes to the outperformance of the market this year, it's really been driven by just a handful of names. Some of those names within your coverage list. There's been talk just about the fact that some of these valuations are so stretched that this momentum that we've seen in the market, it simply cannot continue. What do you think about the outperformance we've seen so far in tech?
Yeah, and I think, you kind of need to pick and choose your spots here. I think there are a lot of companies out there whose stocks have rallied on either a generative AI narrative that's going to take longer than people expect to really materialize, or because there are kind of the belief that, okay, we're out of the worst of the macro environment, and so now it's time to put on that recovery trade. I do believe that we may continue to see a little bit more macro softness before things truly start to get better, and maybe some investors are ahead of themselves here. On the other hand, I think you also have to say what's not being priced into some of these stocks today. And I would say with a company like Microsoft, I don't know that all the upside from generative AI is really being priced into the stock. I know it's not, fully in our models. I don't believe it's in most investor models. And so if they're able to succeed at the pace that they have been, I mean, Microsoft is seeing, they've gone from $0 of generative AI revenue to $600 million of generative AI ARR in 2 quarters. If that kind of exponential pace continues, you could see upside to numbers out there. So that's why I say you have to be really careful and pick and choose your spots. But I do feel like there are a lot of stocks that have gotten ahead of themselves, and I would advise investors to remain cautious on those.
All right, so some caution. All right, Rishi Jaluri of RBC Capital Markets, we appreciate you. Thank you for joining us today.
Thank you.
Coming up, Formula One taking the U.S. by storm thanks to the Netflix series Drive to Survive. We have the CEO of McLaren. That's next.
Formula One is seeing record numbers. Attendance at races up 36% in the U.S., fueled in part by the Netflix series Drive to Survive. One company that has been benefiting from all that hype is McLaren. And joining us now, we want to bring in McLaren's CEO, Zach Brown, and our own Pras Supermanian as well. Zach, it's great to have you here on set. You were on with us about a year ago talking to us just about the fact that the sport, F1, has never been in a stronger position. So what does that mean just about where we are today?
It's fantastic, and I think it's early days, which is amazing. A lot of people are saying, how long do you think it'll continue? And my answer is, I think we're actually just getting started, right? We haven't even had Las Vegas yet. We, of course, kind of came back to the States in 2012. For 20 years prior to that, we were in one place for 3 years, another for 2 years, and we took a few years off. And so we never really kind of had a home. And then, as you mentioned, Netflix, I think, has played a fantastic role. We then came back to Austin. We're now 2 races into Miami, which was a massive success. We have a new television contract, which is great. TV ratings, as you mentioned, are doing excellent. And we haven't even had Vegas yet. So I think long way still to go.
You know, some big prospects here in the States. You know, McLaren 60th anniversary in racing, which is sort of very surprising. The team's been around that long. How has the business changed over the years? I know you've been installed McLaren for a while now. How has that business changed? And also, a lot of sponsorship coming into the series is my kind of take.
Yeah, I mean, you know, the sport's moving a million miles an hour. So on the car front, you know, the technology, you know, there is no more sophisticated technology-driven sport in the world, and the safety and the sustainability around how we go racing is outstanding. The cars are unbelievably quick. So you have that. Then on the fans, of course, we're engaging with the fans through technology, digital, in ways that we never would have done previously. And then, of course, that's drawing in fantastic sponsors, as you can see. We were looking at our race car earlier, you know, the Googles, the Goldman Sachs, the Coca-Colas. These are unbelievable companies that are now entering the sport and seeing, you know, how big and powerful our sport is.
Zach, what has that activity been like? There certainly sounds like a lot of interest from some companies, but given the fact that we are in this uncertain economic environment, are you seeing maybe some of those larger companies standing on the sidelines or maybe reallocating from their original plans?
Not yet, and I keep saying not yet because I'm waiting for it to come. I think the sport is doing so well that the good stuff in life seems to be, I don't want to say recession-proof because I don't want to jinx it, but we're not seeing it. Our numbers are up. We're a profitable Formula One team for the first time in about 10 years. So we're kind of braced for it, but we're not seeing it. We're not feeling it. Quite the opposite. We're having record years, and so long may it continue. But you got to work very hard, because what we are seeing is companies are very, as they should be, ROI driven, and so you just need to make sure that when they kind of go down the list and they start trimming, that they trim from the bottom up, and our job is to stay at the top.
So, you know, McLaren involved in not just F1, but a number of racing series, IndyCar, a new series where they have off-road electric vehicles going all over the place across the globe. What's your take on sort of McLaren's expansion in these other series, and what are you most bullish on these days?
Well, so our strategy, we're obviously in the racing business, and Formula One is what we're all about. That's kind of our center of our universe. But when we looked at what our partners and our fans, our sponsors wanted, some would want a bigger presence in North America. And up until recently, with the kind of Formula One growth, we thought, let's get into IndyCar so we can kind of double down on the North American marketplace. And even though Formula One's doing great in America, it's such an important market, we kind of want to have another layer on our cake versus our competition. So that was the rationale to get into IndyCar. Then we acquired the Mercedes Formula E team, which is all about sustainability. It's electrification, and then Extreme E, which is not only electrification around the world, but it's gender equality. So for the first time, we've had a female racing driver, which is also very important to our partners. So that's kind of our portfolio of activities, along with esports for that kind of grassroots and the younger generation, boys and girls who want to get a steering wheel in their hand at an early age. And so that's our portfolio, which really allows our partners to kind of dial into, I want Formula One, but I want to dial up my sustainability messaging. Can I join your Extreme E team, et cetera, et cetera.
You know, Formula One Group, the shares of the company are actually up. Despite some the market being a little bit choppy, but recently doing well, concern about some ratings dip in Miami there recently year over year. But I think the big race coming up is Vegas, right? That's the one we all want to talk about. That's the one where you may have You were going to challenge one another, Team Motor, to a boxing match. What are you so excited about to see the race there under the lights on Saturday night, I believe?
You know, we've been talking about going back to Vegas. We were there in the early 80s before my time, and it was in a parking lot at Caesar's Palace. And, you know, and kind of the dream has always been, can we get Formula One going down the strip? And Liberty have done an unbelievable job. They've invested hundreds of millions of dollars in the facility. So they're really committed. It'll be a Saturday night race, the first time we've ever had a race on a Saturday. So we're kind of changing up our game too. And I think it's going to be probably the largest global sporting event in the world this year. I can't think of something that's going to be bigger. And the excitement is going to be off the charts. And I can't wait to see, you know, everyone who shows up. It's going to be the celebrities, the athletes, the CEOs, and of course, hundreds of thousands of fans.
Maybe even press.
Hey,
I think if I'm there,
join us.
Taylor Swift's there. F1, I think it'll be a complete blow up in Vegas. So.
We got what, a 5-month countdown? Just under 5 months?
November.
Yeah, there we go, November. All right. Zach Brown, McLaren CEO. Thanks so much for joining us.
Thanks for having me on.
Of course, our thanks to Pross as well. Well, coming up, AMD has unveiled new processing chips that could have a major impact on the race for AI dominance. President and CEO of AMD joins us on the other side.
Major news in the battle for super chip dominance. AMD has revealed its most advanced GPU for artificial intelligence and will start shipping to some customers later this year. Joining me now is AMD President, Chairman, and CEO, Dr. Lisa Su. Lisa, always great to get some time with you. Big day for your company. And I was going over the presentation. Maybe you could explain to the average investor out there, what exactly did you unveil today and how important is it to the future of your company?
Absolutely. Brian, wonderful to see you as always. Thank you for having us on board. It was a big day for AMD. We unveiled a number of new products and a number of customers in our data center and in AI efforts. On the data center side, we talked about new cloud capabilities with Amazon and Meta, as well as Citadel and a number of other customers. And on AI, everybody's talking about AI. We've been working in the AI field for many, many years. And, right now, this is the moment. AI is like the defining megatrend in technology. And we just talked about our very new chip, MI300, which is really aimed at large language model, for AI. So that's the big news of the day.
And Lisa, I always love the names. I've told you this before. I love the names that you put on some of these products. Like that sounds like a chip I need, even though I'm maybe not so sure what I'm going to do with it in my house. But nonetheless, what does the demand look like for some of these products, and when will you start shipping them?
Well, think about it this way, Brian. Everyone has, sort of captured this whole idea of Chat GPT and generative AI and co-pilot functions, using AI to help us in our businesses, in our personal lives, making us more productive and more capable. And the underlying technology for that is GPUs. And GPUs are actually really, really hard to build. There's an incredible amount of technology on here. We're talking about, the most complex chip we've ever built, 153 billion transistors. And the whole purpose is to make AI much, much more accessible. So everybody who wants to use AI needs more GPUs. And we have a GPU that is incredibly powerful, very, very efficient, and we believe will be a significant winner in the AI market.
What is the price on something like this?
Well, it's not about the price of the GPU, frankly. It's about how many users we enable. But look, we're excited. We look at the data center. I mean, this is an incredible market. So if you think about just AI chips in the data center, we think this year it's about a $30 billion market. We think over the next 3 or 4 years, Brian, it's going to grow over 50% every year. So it's going to be like a $150 billion market. And it plays into our strength. It plays into our sweet spot. Everything that we've been doing, in the data center and really putting together our CPUs and our networking capability and our GPU capability is really to help our customers deliver these incredible services to the public.
Let's look into next year, Lisa. Can you make enough of these chips to satisfy what looks to be just blowout demand for all things generative AI?
We are very excited, Brian, about what we see from our customers. Our customers are actually, really excited about ramping quickly. And so, yes, the answer to your question, we have a tremendous supply chain. We've built out a lot of capabilities with all of our partners. And so the technology is ready. We're building out the software that you need, as well as the supply chain.
You know us here at Yahoo Finance, we very much like our numbers. And one of your largest competitors, I'll just call it, let's just say it's NVIDIA. They came out a couple weeks ago and reset expectations financially for how much that company will earn because some of these chips. Do you think the street has to reset its expectations on how much money your company will make over the next 24 months?
Well, Brian, I think the most important thing is to realize that the demand for AI is definitely there. And there are very, very few players that have this technology. We view this market as secular growth. We love our positioning. We think that, what we're doing with customers and the ecosystem is great. And so I look forward to, really seeing that translate into growth for the company as we go through, the next number of quarters as well as years.
And what, in terms of sustainability, Lisa, how much more market share do you have to grab in the data center industry?
Well, I think, Brian, although we've made tremendous progress, I mean, if you think about where our EPYC servers are deployed today, we've made tremendous progress over the last 3 or 4 years. We had some of our largest partners on stage with us today to talk about how they're using our processors throughout their data centers for their most important mission critical workloads. Meta was talking about Facebook and Instagram and WhatsApp. Amazon was talking about their EC2 instances, which are their most important, most popular instances. So we've made tremendous progress, but I can tell you there's a lot more that we can do. And, I view this as an opportunity, not just to be, a CPU player, but really to be an overall data center system provider. And that's where the GPUs are really exciting. Our networking assets are really exciting. And, really this whole notion of deep partnership with the ecosystem is, what we're all about.
Yesterday, I was at Salesforce's AI Day in New York City, and I asked CEO Mark Benioff, Mark, are you concerned about what this AI can do in terms of, just societal changes? I'll put that question to you. Are you concerned about how powerful this technology is? And then do we need some form of global regulatory framework?
Brian, I do believe that we have to practice responsible AI. And I think all of us in the technology industry, have to do that. I think there's a lot of good conversation and good dialogue around what that means. There will be some regulation. There should be some regulation. But I don't think we should forget that the power of the technology is so great that we need to, really embrace it and take advantage of it while also practicing responsible AI.
I've followed your career for some time, and you've had a lot of key moments. One of them, to me, being really reinventing AMD and really bringing it to where it is today on the cusp of this major news in generative AI and various other AI applications. Have you taken a step back and thought about, is this a career-defining moment for you as a leader as you roll out some technology that might change civilization?
Well, Brian, the way I always think about this is, the technology world is all about kind of seeing into the future. Like, we have to decide, 3 to 5 years in advance, like, what do we want to build and why do we want to build it and why does the world need it? And so today is a very special day, I have to say. It is one of those moments where our strategy that we've been working on for the last 3 or 4 years is really coming together. We love all of the work that we're doing in the data center today, but AI is just such a transformative trend. And again, it's such hard technology to build, but once you build it, it has such wide-lasting implications. So yeah, it's a very special day today. And, I love talking about our products. I love talking about what we can do for the world. And, it's a fun place to be.
Well, we have very much enjoyed following your journey and the transformation. I know you're very busy. We'll let you go. A big day for AMD. AMD President, Chairman, and CEO, Dr. Lisa Su. Always great to see you. We'll talk to you soon.
Thank you so much, Brian. Great to be here.
Appreciate it. All right, stay tuned. More Yahoo Finance on the other side of the break.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Disney has updated its release dates for its next set of Marvel, Star Wars, and Avatar films, and fans may not be happy about it. Yahoo Finance's Alexandra Canal is back with us with the details, so break it to us easy.
Yes, I know. Now, Deadline is reporting that this is due to the writer's strike with production currently on pause. Screenplays not fully ready. I did reach out to Disney for comment on that. They did not get back to me. But in terms of those delays, we're talking some major films. 2 Avengers movies pushed back a year. Avengers Kong Dynasty moving from May 2025 to May 2026, which then pushes Avengers Secret Wars to 2027. And it's crazy to think about how far out that timeline is, considering it's just 2023 right now. But this is what experts have been talking about. Due to that long lead time in making a movie, the writer's strike, 2023 was largely going to be insulated. But 2024 and beyond, that's where you were going to see a lot of that impact. And for Disney in particular, they want to make sure that their scripts are rock solid for those Avengers movies, because post-pandemic, they haven't done that well at the box office. And at the same time, too, there's also been a lot of criticism from fans. So that's an important factor as well. And then if you take a look at some of these Avatar films, that's a huge franchise for Disney. A 1-year delay for Avatar 3, which will push the other sequels currently in the works all the way, as you can see, 2029 and then 2031. So it feels like we're very much operating in this post-COVID type of world, or really what we saw during the pandemic with a lot of studios shuffling that release slate. We'll see if other studios, in addition to Disney,
they probably will. I mean, given what we're seeing with the writer's strike and the potential for a SAG-AFTRA strike. But still, it's like we won't even remember the storylines.
I know that, and we've talked about this. I feel that way with TV shows as well. You need someone to explain it to you. You need some sort of recap. Maybe at the theater, that could be something they do. Someone to just recap.
GPT will recap it for us.
That's
They'll be refreshed.
That's true. We need something, because honestly, it's too much lead time. I can't remember all that.
With this. All right, Ali Canal, thank you so much. Part of our week-long series, Real Estate, the New Reality, we're taking a look into the world of the high-end housing market. Luxury homes had a rough start to the year. Began with sales in the U.S. seeing a decline of just about 44%. That's according to the latest numbers from Redfin. But where does the high-end real estate market stand now? Here to discuss, we want to bring in the Altman Brothers team co-founder, Josh Altman. Josh, it's good to see you here. So from those numbers, at least from Redfin, it looks like the luxury market was off to a strong start to the year. Where does it stand today?
Well, I can tell you about California as I'm sitting in my car out front of a listing, because I got a big showing, which is always a good sign. We are at about 20% down compared to last year of May 2022. In LA County, there was about 4,200 sales total up to this point. This year at about 3,200, so we're 20% down with that. But I will tell you, the biggest question, of course, was the ULA measure that was passed. Good news is that even though we had an extremely slow April, May has doubled, and June is looking like it's going to double that. In April of this year, properties over 5 million in the ULA measure areas, which is that new tax that was passed, there was only about 10 sales that month, which was extremely slow. And then the next month afterwards, we had about 20, and it looks like we're going to have about 30 sales now in the ULA areas. So listen, we're all super hopeful about it. That's what I can say here over in Los Angeles.
So we've definitely seen some of that pressure here on the East Coast as well. Josh, Diane here right now. So you're seeing that dramatic impact to luxury real estate on whether you're talking about California, New York. Speaking specifically to California, what is happening to pricing as a result of this drop in demand for luxury real estate?
Well, look, I mean, of course, across the board, the buyer mentality is all about a deal these days. But with everything continuing to move, which is good, believe it or not, May was our strongest month with closings. So that actually shows that our next very strong month is probably going to be somewhere around July, because if you look at the most openings, which were in March, it's all kind of in line here 2 months afterwards. So that's all good stuff as well. As far as the inventory, yeah, we have a good amount of inventory. Good houses still are selling. There's good competition in the lower price points, which in LA, of course, are that $1 million, $2 million range. Things are still moving in that very strong. So look, even though, of course, there's a lot of not great stuff being told about California, LA real estate, I'm feeling pretty good about now considering.
Josh, who has the upper hand then at this point? Is it the buyer or is it the seller? Seems like it's tough to figure out.
Yeah, that's a good question. I like to be really cash heavy right now for the next 24 months. I think the buyer has the upper hand, although I can tell you in any market anywhere, especially with what I deal with, which is the ultra high net worth individuals in the high end market, you build a great house, you build a trophy, there's always somebody willing to pay for it. So we'll have to see what happens.
So, Josh, speaking of that, you building a great house, and you talked about inventory. Inventory has been an issue in terms of general real estate, not so much in terms of luxury real estate, but it is, well, I should ask you actually, is inventory an issue for luxury real estate?
Well, inventory is it is an issue here in LA County, but my other office in Orange County, actually, there's not enough inventory. So it's interesting with just an hour move away there, and also an extremely strong market out there, in my opinion, very undervalued. There is just complete different outlook as far as the market goes. So it's really all these micro markets. And, you know, some of them, of course, have led all the way back to COVID, which, you know, markets like Miami, which have been through the roof ever since. And also, of course, taxes pushing other places, Las Vegas, Arizona, Nashville, Texas, other places like that. Still very strong, I got to tell you.
Josh, how has the demands, or have they changed from the high-end buyer here, just in terms of what they're looking for, what their preferences are at this point? Is it different post-pandemic than what we were looking at 4 or 5 years ago?
Yeah, that's actually a pretty good question. Before it was location, location, location. Now it's walking location, walking location, walking location. That's what we're seeing out here. Everybody wants to just be in the mix, because if they are going to have their everyday life, they want to have the ease of just in case anything happens again, they want to be close to everything. So that's really what's driving the market here. Also, look, styles change, of course. What we're seeing here out in LA is the earthy tones are just killing it now. Everybody likes the very simple stuff. No more shiny stuff. That had a trend about 5 years ago, which thankfully is done now. But yeah, you know, different neighborhoods, of course, have gone up and down. But, you know, here where our office is in Beverly Hills, continue to be strong. But mostly, I will tell you, because we are not affected by that ULA measure that was passed in most of LA County.
Josh, I want to ask you about the impact of State Farm Insurance pulling out of California. What is the impact to the luxury real estate market, considering State Farm was the biggest home insurance provider in Cali?
Yeah, I'm not going to lie. My phone blew up when that went public over the news a couple weeks ago. It was hard enough as is. So now that they bowed out, that's going to be a real issue, especially, look, in those heavy fire markets where, of course, you gotta, you know, you're paying premium for that. Now that's going to be a major blow to those properties. And because most of them here in California and some of those areas like Mulholland Drive, the famous Mulholland Drive, try getting fire insurance up and down Mulholland right now. It's near impossible. And yeah, when your fire insurance is double your mortgage payment every month, that's a big issue. That makes, you know, you're going to see a drastic drop in those markets more than any before. So I'm glad you brought that up. You know, over time, we'll see who jumps back in, but it's not good.
All right. Well, that will be certainly a space to watch. Thank you so much for joining us today, Altman Brothers team co-founder Josh Altman. We appreciate you.
See ya.
All right.
One titan of real estate, Barbara Corcoran, also taking part in our series, Real Estate, the New Reality. Well, I sat down with her recently, and of course, We talked about housing, but she also spoke out on the lending environment right now for small businesses and the startups you often see on Shark Tank. Let's take a listen.
They're desperate for money. Most of the people that came on Shark Tank 2-3 years ago were always getting funding. That's not the case anymore. The market's too nervous. The only funding in town is usually when they stop at Shark Tank. And we're silly enough to invest in their businesses sometimes, okay? Or very wisely invest in other good businesses sometimes. But it's difficult to get your hands on money as an entrepreneur. But I don't really believe you actually have to have the money to get started today. You could do the funding online to a degree, and you can rely on your own chutzpah to get up and get going without having investors in your business.
Have you changed how you're looking at investments, potential investments at all, given the current environment?
Yeah, I'm very particular about the entrepreneur more than ever. I've invested in over 150 businesses or thereabouts. Every one of my home run hits is because the entrepreneur is phenomenal. The entrepreneur is going to make it no matter what, and it has nothing to do with the product they sell. It has to do with how hard they hustle.
So there you have it, Diane. Barbara really saying that right now the current landscape has changed how she is approaching investment. She's still very confident in those that she is investing with, but we see it reflected in the numbers. VC deal activity, $37 billion in Q1. And putting that in perspective for everyone out there, that's down from $82.4 billion the year before, a 55% drop. So it certainly is a very, very tough environment for startups who are looking for that capital that they need to grow.
Right, and not surprised, I'm a big fan of Barbara, obviously, and the show Shark Tank. And I even noticed within the show them being choosier about what deals they get into and but it's not surprised that she likes the plucky entrepreneur type. You know, she certainly started that way. I love that you were in her home. I love that footage that we're seeing right now. That was super exciting. And you know, I also think about her comments about real estate in general, commercial real estate. So, you know, I know that that's an area that we've been looking at and the challenges there. And she's echoed some of the things that we've seen in different analysts we talked to. We know UBS put a note out earlier this year about commercial real estate and the challenges there. We talked earlier in the show about that and them having to do conversions within, you know, to try and kind of convert the issues that we're seeing with commercial real estate and take on the issue of housing. So not surprised to see that, and also to see the dryness that you're talking about with regard to the VC activity.
Yeah, certainly it is a very tough environment right now when it comes to those VCs, what she's doing with her investments. When it comes to real estate, we're actually going to talk a little bit more. We'll show you that interview tomorrow. Make sure to tune in. Barbara Corcoran will give us her take on everything from commercial real estate to what she's seeing in housing and why she's saying that now is a great time to buy, despite the fact that there's an inventory shortage and higher rates here. So real estate, the new reality with Barbara Corcoran. We'll have that for you tomorrow. All right, well, Salesforce announcing a new suite of products at its AI Day this week, which could better position the company in the race for AI and capitalizing on all of that excitement. Well, our own Brian Sozzi got a chance to check out some of that new technology. He also spoke with Salesforce Chairman and CEO Mark Benioff about the company's initiative surrounding AI. Let's take a listen.
We've seen a lot of exciting waves of technology in our industry, the cloud, social, mobile, but this AI wave is going to be the biggest that anyone has ever seen. I think that the success of OpenAI is the point of evidence that this is going to be one of the fastest growing moves, not just in the consumer market, but in the enterprise market. And we had some of the largest, most important enterprises in the room today, and every customer is excited to get their hands on our new generative AI products, which are shipping this month.
You said something in your presentation really early on that said, this is the new Salesforce. What did you mean by that?
What I mean is, we've been very focused over the last 5 months of transforming our financials. We just delivered our highest margin ever. We are extremely excited about our new management team that we've introduced last week, and now a whole new product strategy as well. And I think the right combination of financials, people, and technology is the right capability for this software company, which has become the third largest software company in the world and is really just getting its, sea legs when it gets to the next generation of artificial intelligence.
I saw a lot of presentations or a lot of screens up there on GPT this, GPT that. How will that change Salesforce, and what does the order flow look like for those products?
Well, about 10 years ago, I had my first existential freak out about AI, and I ended up buying a lot of companies and assembling teams and making things happen. And that was very exciting to me. And this is bigger because this is now the next wave. Of course, Salesforce is already a leader in AI CRM because of that. We introduced Einstein in 2016. We're doing 1 trillion transactions a week of Einstein. Now we're going to enter generative AI as well. I think it's going to be another wave. The amount of data that we already see being entered into the system through our data cloud is at record levels. So I think it's an indication of how well these generative AI systems will do.
I think a lot of folks on Wall Street, they're interested in how does Salesforce monetize all this amazing new technology? How do you see that?
Well, today we introduced all kinds of new monetization models around generative AI, including our AI Cloud, which is our starter package to help customers move forward. It's $360,000. It gives you all the licenses and capabilities and services to get going. I think for a lot of customers, trust will be the most important thing. They're going to want to make sure they don't have any data leakage, that their companies and their employees are properly trained to work in this area, and that all of the corporate playbooks and customer data sets aren't going out the left window. So that's our job, to make sure that the company's architected correctly and ready to go for this new generative AI era.
You seem very passionate about trust and doing AI from an ethical standpoint. Do you anticipate some form of global regulation here at some point?
I think trust and generative AI are going to go hand in hand, and then responsibility and generative AI. I think this idea that AI is kind of at a next level is true, and I think every business and every government and every individual is going to have to come up with their own way of looking at this technology and what is the right way to manage it.
Do you view AI as job creating?
There's no question that AI is going to create more jobs. It could also take jobs. It can be a balance. In the work that we showed today, which is something that's been going on for 18 months with Gucci, we've actually seen the Gucci call center expand, because what it did was it made their employees more capable, in their own words, to augment their call center. Now the call center, which only did service, also can do sales and marketing and commerce as well. That's a big step forward. They call it Gucci 9. It's like a next generation capability, and I'm excited to go to Milan and see what's going on there. It sounds expensive.
It sounds expensive. How important is it? It wasn't lost on me that you're in this room, you're a co-founder, Parker was in this room, co-founder, that Salesforce is founder-led at a moment like this. How important is that from
Founders can go faster, you're 100% right, and I think that we've transformed the company a lot in the last 5 months. We go back and look at the interview we did 4 or 5 months ago, the interview we're doing now, the questions are different.
Old, but yes.
The questions are different, the position is different, everything is different, because we've transformed the company in a relatively short amount of time, and we're excited about where we are and where we're going.
How has that, the past 5 months, changed you as a leader? Because you're always very passionate about this, but there was a different level of focus here today, and I don't know, it was really cool to see you in that zone.
Well, I think number one is we've really focused on changing the financials. And you saw we just hit our highest margin levels. We've increased margins by 1,000 points. That's tremendous for our investors. We just hit some record cash flow numbers. You reported that as well. And very excited about the quarter we just delivered. Number two is we brought back some great leaders. We had our new Chief Marketing Officer here today, Ariel Kelman. Of course, Ariel has worked for Salesforce for 6 years, running product marketing. Then he went to AWS, where he was the CMO for 8 years. And then he went to Oracle as the CMO for 3 years. So we're very excited to have him back at Salesforce. But also, we have a number of new executives that we're very excited about, and augmenting also our Chief Operating Officer, Brian Millham, giving him some great new capabilities, including leading our business technology team and our HR team, as well as our marketing team.
Does it take time for these new, or this next generation of leaders to settle in? How do you think about it?
Well, I just brought back my former Chief Marketing Officer, Kendall Collins, as my new Chief of Staff. And it's been great for me because he already hit the ground running. He had been with Salesforce for, a dozen years, left for a few years. Bringing him back, he was able to hit the ground as if he never left. And that's the kind of executive I like right now.
All right, our thanks to Salesforce Chairman and CEO Mark Benioff and our own Yahoo Finance's Brian Sazi. Coming up, it is closing time here on Yahoo Finance. We'll run through everything you need to know from today's biggest news. Stay tuned. It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. The May Consumer Price Index showing inflation is rising, but at a much slower pace from a year ago. Headline CPI coming in at 4%, and core consumer prices rising 5.3% from last year. While inflation is still well above the Fed's target, markets are betting the central bank will pause its rate hikes tomorrow. The CME's Fed Watch tool has the odds at a nearly 91% chance that the Fed will hold rates steady.
Meantime, a milestone for Nvidia, the stock closing at $410.22 a share, driving the company's closing valuation above $1 trillion for the first time. In recent weeks, the stock did flirt with that valuation on an intraday basis, but couldn't close at that level. Shares moving higher today following strong earnings from Oracle.
And former President Trump entering a not guilty plea to all of the criminal charges he faces in the classified documents case. The charges include mishandling classified information and obstructing justice. After the appearance, Trump made an unscheduled stop at a bakery on his way to the airport. He met with supporters, and some even sang happy birthday ahead of Trump's 77th birthday. That's tomorrow. Later this evening, he is expected to speak from his Bedminster Golf Club.
All right, well, that will do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here tomorrow, 2 p.m. Eastern Time. We got the Fed decision for you. We'll have that for you live right here on Yahoo Finance. See you then.